Hello, everyone. My name is Dan Veru, and I'm the Chief Investment Officer of Palisade Capital Management. We're so fortunate to have Jim Fury, founder of Fury Research Partners, with us today. His firm has decades of data and information on the broader markets as represented by small and mid-cap stocks. Today, we're going to discuss the financial markets as we begin the second half of 2026, where we now have a new chairman of the Federal Reserve, and Kevin Warsh, who just had his first kickoff presentation yesterday. And in the fall, we're going to have the midterm elections, which are obviously going to introduce some additional excitement into the markets. So the first half of 2026 has been certainly a frustrating period for many active managers and was marked by very narrow leadership centered around artificial intelligence and the build out of data centers, with only a handful of companies driving the returns of the indices. However, it's interesting to note that in June, only Apple was the only member of the so-called Magnificent Seven technology leaders to make a new high. Yet the S&P and the S&P also made a high on June 2nd, as it was coincidental. But the breadth in the market seems to be changing, and that's what we're going to be talking about today. 8 out of the 11 sectors of the S&P were rising and outperforming relative to the previous leaders, which were energy, communications, and the technology stocks. Quietly and with very little media focus, the Russell 2000 and the equal-weighted S&P 500 are making new all-time highs, while the S&P itself seems to be going more sideways. So again, I know of no one more qualified to discuss the opportunities going forward as we enter the second half of the year than Jim. And, again, our topics are going to be about the broader equity markets, which is really best expressed by the opportunities for small caps. And that's the area that Jim and his colleagues have decades of expertise, seeing many market cycles where small to medium cap stocks have underperformed relative to large caps, and in periods where they have outperformed. So Jim, thank you. Welcome. And why don't we kick things off?
Terrific, Dan. It's great to be with you. Thanks for inviting me.
My pleasure. So, the first topic I want to talk about. History suggests that the midterms are often a period where stocks become more volatile, and you at times can have corrections along the way as well. But does that same pattern emerge for the broader markets like the Russell 2000? And how long and persistent has this pattern been? And why do you think it happens that way?
So, Dan, in about half of the midterms since the early 90s, small caps have fallen modestly. And in 3 of the other 4 years, midterms, they've only risen modestly. And the only time they really had a strong gain was in 2010. And of course, that was following the great financial crisis. So there is a history of consolidation in the 6 months leading up to the midterm elections. And this year has been quite the opposite from that. Actually, since March of the end of March, we're up 18% as the market has sensed a strongly improving economy. Traditionally, which is your question, in the 6 months prior to an election, there tends to be great uncertainty about where policy and the economy are going to be going, and therefore stocks go sideways. There's also a little bit of, oftentimes after a presidential election, the policymakers put in the medicine that sets up the 4-year cycle to aid the presidential cycle. In the first year of this administration, the one big beautiful bill was passed with a lot of stimulus in it, and we're finally starting to see the economy work for small caps and the average company.
Yeah, it's interesting. And if you could move to the next slide, please, because I think this is also while markets can get jittery in the period after the election. That's a pretty good time, as your slide, as this slide that you prepared shows.
Well, in the 6 months after the election, you're up in 6 of the 8 6 months. You're up in 6 of the 8 instances, and the market is consistently strong. So yes, absolutely.
Yeah, that's interesting. Yeah, as I said in my introductory comments, it's incredibly narrow. It's extraordinary how narrow the rally has been for the S&P 500, but it's also been incredibly narrow for the Russell 2000. A lot of the smaller cap companies, the large cap companies, most people have heard of, but small caps, a lot of the small caps that we've seen move just seem to be almost disconnected from valuation metrics and all that. But I'd love for you to just discuss perhaps, how narrow has this rally been in the away from the companies that everybody's heard about, of the technology leaders. Could you give us a little bit of sense? And I think we have a slide to show that in the next slide.
Sure. Keeping with your theme of sectors, we actually have only had two sectors outperform year to date, and that is technology and industrials. But making it even more difficult is inside of technology. The semiconductors have been so strong. We have seen record divergences between the leaders in the technology sector and the rest of the technology industry. In fact, when you lined up all of the technology companies in the small and mid-cap space, the difference between the 90th percentile and the 10th percentile company was 70% in the trailing month. We've never seen anything like that. And so it's made it very difficult unless people were in the exact stocks. But the encouraging thing is we are starting to see some breadth starting to come, and that should occur as the economy improves. Something that a lot of people don't appreciate is small caps actually had zero revenue growth in 23 and 24, as defined as the Russell 2000. And their earnings fell roughly 20% each year as their costs went up. And now, as the economy broadens and improves, we're starting to see revenue growth accelerate, and it's up to what we think will be at least 7% this year. And because of all of the cost cutting that those prior 2 years of a lack of revenue growth produced, the operating leverage is terrific. And for the first time in years, small caps are poised to actually have stronger earnings growth than large caps. We expect roughly 25% earnings growth this year, 27% next year, when large caps are actually seeing peaking revenue growth because so much of their growth came from the Magnificent Seven, which are now in an unprecedentedly heavy investment cycle, which is damaging their earnings.
Interesting. So could we see, we have a slide here where a pullback in a secular bull market wouldn't be bearish at all and wouldn't indicate any longer term trends. But could this be something where we don't really even notice the pullback because there's so much rotation going on within the index? And the reason for that question, one of the reasons to own these fantastic technology leaders in the S&P has been that they were huge free cash flow generators and they were very asset light. And because of the investments they're making in artificial intelligence, it's astounding how much capital is being raised and deployed for the artificial intelligence build out. So they're becoming almost asset heavy. By contrast, to your point, the revenue growth seems like it's more exciting for the broader markets versus the narrowness within the S&P.
I think that's absolutely true, Dan. And I might expand upon your point a little bit and make the point that going into this heavy investment cycle, the largest cap tech companies were priced and valued as free cash flow machines with pristine balance sheets and the highest profit margins the world had ever seen.
Yeah.
It remains to be seen what those models are going to look like in 5 years, but we know what the models are going to look like increasingly over the next several years. And the balance sheets are under such stress, something that no one believed would happen,
Right.
In the form of Google issuing stock, Oracle issuing stock, and then it's expected that Meta and Microsoft will also issue stock.
Right.
So you've had actually in the large cap space a tremendous amount of equity issuance when you include SpaceX. And then if you anticipate that OpenAI and Anthropic are going to come public, you're going to see a large draw of capital. And in fact, we're already seeing that. Of
Right.
the top 10 market caps in the US, 8 were down in the trailing month prior to last week, most in the range of 5 to 7%, while the Russell was up 3.5%. We spent a decade where small was lagging. And
Yep.
so, it doesn't take a lot of money to move small caps. And
Right.
we're seeing the first signs that this is occurring. And in fact, small put in a relative bottom compared to large in April of 25 on the so-called Liberation Day. And
Right.
we've been outperforming ever since.
Yeah, amazing. So, and you make some excellent points on this slide that even if we get a pullback or a correction, the structure of the bull market is very much intact. It just might be a different groups of stocks that might grab the mantle from only the tech related names.
Exactly. And I think the key ingredient is earnings growth. And we in small caps have lagged large cap earnings growth over the last decade. And it's because these magnificent companies took their net margins from a prior peak of around 7 or 8% all the way up to over 12%.
Yeah.
And when they also posted superior revenue growth, it just wasn't a fair fight.
Yeah.
Well, now it is a fair fight because the economy is actually accelerating as a result of onshoring as well as the AI build out. These companies, the largest, are building a lot of infrastructure, and it's trickling down into the small cap companies.
Right.
And we're starting to see that occur. And
Yeah.
it's occurring, as this slide shows, at the exact time that small is as cheap as it's been going back to 1990 relative to large. So if we finally have some relative earnings strength, the setup is present where the valuation can show we'll get both valuation expansion as well as earnings growth. But you really need the earnings growth because small's been cheap versus large for a number of years.
Right.
And it really doesn't matter. Investors like the relative earnings strength.
So now you have a catalyst. And as I like to say, when you have valuation in your favor, it's hard to break your leg falling out of a window. The valuations for a lot of companies are pretty high. But so I think what you're saying is we're starting from low valuation at a time when you're getting that acceleration. So you can really win two ways, from just the earnings growth and potentially from multiple expansion.
So I put a couple of caveats on there. One of which is large caps are clearly expensive. And in fact, I think you have that on the next slide,
Yeah.
Which goes back to 1990. One looks at all of the companies, and then in the other, we take out the Magnificent Seven. And you can see that the only time large caps have been more expensive was just by a sliver during the internet bubble. But
Yeah.
small caps have average valuation. And then I think that's on the next slide. So if you can see a little bit of rotation like we've seen in the last month as money is rotated out of some of the largest companies to both fund SpaceX and then it'll fund other things. Some of it is also finding its way into small caps.
Yeah.
And that's why they're outperforming so much. You know, we're up 18% year to date, and we're outperforming by roughly 10 percentage points. No one's paying any attention because it's been 14 years since that's happened.
Yeah, that's it certainly doesn't make it into the financial press about what's going on in small and mid. And even when you look at things like the equal weighted S&P 500, which is also, making new highs. Aside from the midterms, we've obviously got Kevin Warsh is the new head of the Federal Reserve. He had a much shorter speech yesterday than I think his predecessor had. Not to get too deep in the weeds on the plumbing of the Federal Reserve, but the history of new Fed chair at the very beginning is that there's a sort of a breaking in process. The market's got to get used to their cadence and how they present, but sometimes they make goof ups, and that can have pretty broad market implications. As I recall, when Chair Powell came into place, he had made some statements, early in his tenure about draining liquidity, and the market really had a problem absorbing that information. But what's the history like about that? And is it does it really matter? Are these really just kind of short-term issues that can hit the markets?
Well, history has not been kind to a lot of new Fed chairmen. Volcker came in as inflation was, well over 10%. Greenspan came in right before the crash of '87. Bernanke was greeted with a great financial crisis. So the timing of when you start matters. And in the case of Powell, the amount of liquidity in the banking system with reserves was also getting very low as he was coming in. I was so impressed with Warsh yesterday. One of the things I think he will not be doing is he is not scared of the markets. He is a market participant, has been, and he has a focus, I believe, on getting money into the real economy as opposed to into just the canyons of Wall Street. And why this matters is because if he can accelerate the economy through his monetary policy, that's going to be good for small caps because small caps are highly cyclical. And as I pointed out, when in 23 and 24, there was no revenue growth in small and large cap had it, small lagged terribly. We're now seeing just the opposite. So I was impressed with Warsh, and his policy goals should be favorable to the economy, which should be favorable to small caps relative to large.
Yeah. So if he's favorable to the economy, does that as this slide I think is really important for people to look at, the market concentration could be peaking if what you're saying, we're seeing some bits and pieces of that starting to happen now. But I thought this was an amazing slide to put in historical context of just how concentrated we've in fact been so far, and that we might be coming to the end of that extreme concentration.
Yeah, our Adi Karande created this, and the blue line in the left-hand scale represents what the top 5 companies represent in the entire S&P. And you can see it peaked at over 30%. Now, everyone thought that the market was concentrated with the Nifty 50 back in the early 70s when this chart started, and it was only at 24%. What's interesting from a small cap perspective is the orange line is the relative performance of small versus large. And when this blue line starts to head down, small caps outperform, and by a lot. And in fact, if you look at the right-hand scale, you can see the multiple of small versus large. It's been so long since small has had a good run, you forget about this. The last run we had with small caps was off of the March 20 COVID low. Small caps jumped over 100% and outperformed by about 50. That, unfortunately, was a blip in the large cap cycle, which has lasted over 14 years. But if, in fact, the large cap companies are under distribution because their ownership is peaked, their earnings relative strength is peaked, their valuation is expensive, if this line comes down, history indicates that the orange line, the small cap relative performance, is going to head up. You know, you look at where the orange line last had an up move that was substantial. It was in 2010. So, you know, that's a long time. And the most expensive words in the markets are, this time it's different.
It's different. Yep.
Well, yeah. Historically, the largest companies are not the most rapidly growing. They have been for a long time. Because of all their investment, they may not be in the future, at least for the next few years.
Interesting. Yeah. And there's obviously a big debate about inflation now, and fortunately, since some sort of a truce has been signed in the Middle East, you know, oil prices have started to come down and accelerate to the downside. But that's only one component of inflation, obviously. But how do small caps or the broader market do in an environment where inflation comes down? Because I think when inflation was high, tech still was able to really outperform.
Well, the high inflation punished small caps. Their revenue growth couldn't keep up with their expense growth. Small caps history with inflation depends upon where you are in the cycle. The strongest small cap returns actually occur when the economy is accelerating and inflation is moving from a low to a higher level. And in fact, it continues to be a very favorable small cap environment until inflation moves above 4.5%. It's at that level that typically the Fed puts on the brakes and the juice leaves the economy.
Right.
But I actually happen to have a little bit of an out of consensus view around inflation, and I actually think it's shared by Kevin Warsh. He actually ended his press conference yesterday with what I thought was a very interesting statement that was a counterpoint to the hawkishness that everyone focused on. You may recall that he said, AI is the largest innovation and advancement in my lifetime. And this Federal Reserve is not going to be scared of an economy that grows rapidly if the inflation is not moving higher. I happen to believe that AI is going to be a tremendous productivity boost. It's going to be very deflationary. And currently, the strength in the market is being driven both by productivity gains and therefore profit margin improvement due to AI. But also investors have been betting that the next move down in energy prices, as the war was not going to last forever, would be down. And so we've already seen oil fall from a peak of around 110. It's now at 74. The inflation numbers are going to be coming down, and everyone's looking in the rearview mirror. Stocks look forward. And so what we're seeing is an economy that has a tremendous amount of stimulus built into it. We're already seeing the revenue growth occur. We've taken a shot to the animal spirits through energy prices higher. They're collapsing now. And if the productivity and profit gains create a reflexive cycle of investment, this is the kind of gains that are going to accrue to small caps. So when Warsh says he's not scared of high growth if inflation doesn't take off, I think this is the next 3 to 5 years. Inflation is going to surprise to the downside. If you look at Warsh's favored inflation measure, it's the trim mean PCE. Right. And it's down to 2.4%, just like the core PCE has been falling on a 12-month basis. Excuse me, the 5-year inflation expectations have been falling. Right. So the marginal change is going to be very positive, I think, on inflation.
Yeah, interesting. In the last few minutes before we take a couple of questions, that this word quality, when looking at stocks, gets bandied about quite a bit, and and that's been something that's been troubling to many of us as we see companies that are either pre-revenue or have limited revenue and no profits, yet garner incredibly high market caps and big performers. While companies that are profitable, generating cash, buying back stock, investing in their business, so on and so forth, those stocks have somewhat been ignored. But the point that you're making seems to be favorable for having a quality bias when you're allocating capital.
Here is a statistic that is just incredible. And again, I've got to thank Adi Karande from our firm. Do you know what percentage of profitable companies in the Russell are outperforming year to date? 17% of the profitable companies, and most institutional portfolio managers own profitable companies because over the long run, they do better than loss makers. Right. But in this most recent move, starting this year, only 17 have outperformed. So this is a chart which looks at one take on quality, and you can see this goes back to the 1990s. The quality portfolio, if you will, that this represents is as cheap as it has been going back to 1994. I'm a much better buyer of quality than I am of money losers. And particularly if the economy improves and interest rates are stable to slightly lower, the money losers are not going to see the kind of multiple compression that interest rates are not going to see the interest rates come down for them to be able to do well. So I fully anticipate this quality line is going to start to move up. And with it, we'll see the average institutional portfolio do better. You have to bet against history.
For that not to happen. Yeah.
Yes.
Yeah. No, that's interesting. So we have one final question from me, and then there's a couple questions from the field. Obviously, you're showing here quality without financials because of the unique aspects of how they generate profits, but biopharma, which historically have not been profitable stocks. But away from that, away from the biotech trade within healthcare, there seems to be a lot of valuation support, and just we're observing that all of a sudden, healthcare is starting to move a little bit, starting to come alive a little bit. What do you think's behind that?
Well, I think the portfolios are now so extended with their gains in technology and industrials, they're looking to redistribute those. When you look at past bull markets, it's interesting. People say, well, coming out of the April 25 bottom, does this look like a typical bull market? We're actually only about 6 percentage points above what's a typical rise out of a major bottom. And the industries or sectors that do best are typically technology, healthcare, energy, and the consumer discretionary. Technology and energy have done very well. Consumer discretionary and healthcare have not. So we're seeing in our work for the first time this past week, we actually started to see some accumulation that mattered in consumer discretionary. And we're starting to see better breadth in healthcare. We actually had a very strong move up in the beginning of the year in biotechnology. That's now stalled. And the better performance in healthcare is coming from the more traditional companies. I know healthcare insurance is an area that was badly beaten up. That's now starting to show some life, but it's even broader than that.
Yeah, interesting. Okay, so we got a couple of questions from listeners. The first one is on bonds. All the news on the broader economy seems positive, but what do you think of bonds in this environment?
Well, bonds have a role in any portfolio for stability as well as for income generation. But the U.S. government has a problem. It has a big deficit, and the deficit is larger currently than nominal GDP growth. So in the structural reasons for a bull market, if you have to generate nominal GDP growth to service the debt, that is by definition going to be more friendly to equities than to bonds. So we are in the midst, and it's been this way for many years, of financial repression. So bonds will earn money, they will lag stocks, but they serve as a portfolio stabilizer. Though it is interesting to see the correlation between stocks and bonds have turned positive, and the 60-40 portfolios inverse correlation that had gone on for so many years has not been working over the last couple of years. But, bonds are there for particularly high net worth individuals. They're not to be ignored.
Right. Yeah, that's great. And, on the broader economy, do you worry about a recession? Obviously, this year we're halfway through. You don't have any of the signs, but what happens in 27 or 28?
Things can change, but we had oil go to over $100 a barrel, and it did not damage the economy. All of the signals that would indicate risk are heading in a very favorable direction. High yield credit spreads are very tight.
Right.
In fact, you worry that the marginal change is going to be bearish because it's so positive. But in the current environment, it is very bullish. Warsh himself made the comment that when asked to characterize monetary policy, he said mixed, because in the housing market, it is restrictive, but in the rest of the economy and the financial markets, it's stimulative. This is part of the structural reasons why stocks are going up, It's because of the large deficit that hasn't gotten any smaller for structural reasons. The policymakers, fiscal and monetary, are caught in a little bit of a pinch. So they have to try to do everything they can to juice nominal growth to service that debt. And by the way, capital gains are very important. 4% of the entire budget for the fiscal government comes from capital gains. So if we have a major bear market and that goes to zero, a 5.8% deficit would immediately go next to 10% of GDP, and that's before the stabilizers kick in. The point being is that fiscal and monetary policy is naturally positive because we have this deficit problem that is forcing their hands.
Yeah, interesting. You referenced the last time, it's been a long time that we've had a sustainable period where small caps outperformed large caps. When was that? And are there similarities? Obviously, as things don't repeat themselves, but they definitely rhyme. And I'm just curious if the one question and what I was thinking through is, is today's environment similar to that period, that setup?
So we had a strong period of outperformance off of the COVID bottom, which I referenced earlier. The prior time was coming out of the great financial crisis. And so, great big bear markets make for big small cap bull markets. And that's because they typically go down more and then come up. A more sustainable small cap bull market in a normal economy has to be one that's cyclically strong. The best comparable period is 75 to 82, where the overall market struggled, but there was strong nominal GDP growth and small caps were able to grow at a faster rate than large caps. But out of the great financial crisis, we had a nice bull market for a few years, but it ended in 2012, 2011, and it's been 14, 15 years since small caps have had a cycle. And in my career, I've never more felt like the Maytag repairman. And, there are probably a few people that are old enough to be able to know who the Maytag repairman is. You ask young kids about that ad and they have no idea. But these small caps are so underowned. And one company alone, NVIDIA, was worth 130% of the entire small cap market at the end of March. And we have similar situations in Microsoft, Google, Meta. And so it doesn't take a lot of money to have these things move. And it looks like now we finally have a setup with nominal GDP growing. And the reason it's growing is because of onshoring, AI investment, and things like the immediate expensing of CapEx.
That's big.
That just creates animal spirits in people who want to spend money and who see opportunity.
Yeah, that's interesting. Yeah, well, one final question. So, and there's a few questions I'm kind of consolidating into one. Getting back to healthcare. Do you healthcare has been such a tough area, not just in the recent period, but for some time, almost like a very long overhang from the 2021 peaks for the sector. But do you think if there's leadership change within the House and the Democrats, because again, obviously the majority is so small here, could part of the rally in healthcare just be a result? And you mentioned managed care companies, maybe. If there's policy shifts that are more supportive of healthcare, of of policies supporting healthcare. Could that be what the market is starting to sniff out? Could that be tied to perhaps a leadership change within Congress?
So it could be. I feel like this is not my area of expertise.
Yeah.
And the legislative changes that have been at the fore over the last number of years have been anti-healthcare. And so that has come to be expected. And the budgetary pressures from healthcare are so large that I think the best opportunity comes from rotation.
Right.
The strength in technology and industrials was just so dominant as money comes out of those areas. But it's out of my lane, frankly, to give an informed opinion on that. So I'm sorry to.
No, that's fine. That's fine. No, another question just came in on interest rates. If rates start to rise, how do small caps do in that sort of an environment? Can they coexist with higher rates, or is that really something that really hurts valuations on small caps more so than perhaps large cap companies?
So this is a very good question. And there are two reasons that interest rates can go up. One is inflation, the other is growth. And what we have just seen is a test on where rates would go with an inflationary surge. And the 10-year didn't even really challenge the 4.74% kind of top of the range. And now we're back below 4.5%. We're in a trading range between 3.8, I think, and 4.7%. So the point would be is that if we get growth and that puts upward pressure on interest rates, that is not going to be a negative. We have data that shows that when interest rates go up, if it's growth related, small caps do beautifully. If it's because inflation is rising and the Fed decides to end the party, then it becomes a negative. It is my view that we're going to have financial repression in addition, if it's needed, but the deflationary vectors of falling oil prices and then AI investment is actually going to take a lot of pressure off of interest rates. And I'm a much better buyer of bonds to have lower interest rates over the next year than I am higher. And I think that's going to be one of the major surprises to policymakers, is that the growth will not be inflationary to the same degree people expect.
Just to conclude, and that's kind of the conditions we had in the late 90s, when you were getting huge productivity gains from the investments that were made to set up companies for the internet.
And globalization.
Yeah.
Now the deflationary vector won't necessarily be the internet or globalization. It's going to be AI and the pace and speed with which it's coming. Dan, I know you've spoken about how it's starting to influence your company. I see how it's influencing the productivity of ours.
Yeah.
It's very exciting. It's allowing you to do more, better with less.
Absolutely. Well, that's a good place to end, Jim. And I can't thank you enough for what was a great discussion. For all those who listened, really thank you for joining us today. Jim, really, we're privileged to have you join us today. You're one of the thought leaders within small caps, which I just think are the best representation for what's going on in the real economy in the United States. So thanks, everybody, for joining us today. And hopefully we'll have a chance to have Jim back again at some other date. Thank you.
Thank you, Dan. Pleasure to be with you.
Bye.